Hi, IBD. I'm Meredith Heyman. This is IBD Explains. Thanks so much for joining me. The monthly personal consumption expenditures price index report, or PCE report, gives a good outlook into the economy. IBD news editor Ed Carson is breaking down what investors need to know about this data and how it will affect the markets. Ed, thanks so much for joining me.
Hey, thank you so much.
Absolutely. Now, what do investors need to know about the monthly PCE inflation report? And let's go further into the other inflation reports.
Yeah, I mean, there's sort of three major inflation reports in the month. The PC, which is the Personal Consumption Expenditures Price Index, the Consumer Price Index, and the Producer Price Index. The PC Price Index and the Consumer Price Index are both consumer inflation measures, sort of like what we're paying, for out there. The real differences is that, well, there's differences between the two of them. One of the most important is the Fed has decided it likes the PCE price index, and especially the core PCE price index, which excludes food and energy, as its favorite inflation gauge. So that is really important. PPI is also important. The producer prices is more measuring wholesale inflation or inflation at more of the earlier stages. And it does give you an idea, and it's more about goods rather than services. But it's also a measure, and it's also an important measure. These are things that are important for treasury yields. It's important for the Fed rate outlook, and as a result, it's very important for the stock market.
Ed, you talked about the Fed. How do these reports influence interest rate hikes and cuts?
Yeah, I mean, look, they're looking at this data. I mean, they're very data dependent, and they're just trying to gauge out and how things are as the inflation data actually comes out. If the inflation is higher than expected, then they may want to hold rates or raise rates. If inflation comes down a lot, they may want to be cutting rates. I mean, it's fairly straightforward. Now, it's not like one report is going to change everything. It's like there's always one-offs, and so it's not like, oh boy, this was a hot report, or oh boy, this was a cold report. But it's just like they're looking for that trend. So if it's this month and then next month and then next month, and so start looking at that year-over-year change, or 6-month annualized rate of change kind of things, like that trend. That's what they're really looking for, and so and the Fed will definitely react to that.
How do these reports, these inflationary reports, and personal income influence the bond market?
Well, I mean, the inflation measure, like the treasury yield, especially on the short end. The short end is very tied to Fed policy, so that's going to move a lot with that aspect. And look, I mean, if you're buying bonds, you want to make money beyond inflation. So as inflation rises, that's you're covering that. That's really important. I mean, that treasury yield surged to like a multi-decade high 2023 because of expectations, because inflation was high and expectations of Fed rate hikes. And so as inflation started to cool, we saw a big drop in that. And that's the same things we see that in time. So inflation comes up, those treasury yields are going to go up, and we had this long, like 95 to almost 2020 kind of low inflation era, and that kept treasury yields low, and that's really a positive for that was a really positive for a whole lot of reasons, especially the stock market.
How do these reports influence the stock market?
If you can put your money into bonds or treasury yields like a 3-month bills and get 5%, or if it's 10%, well, you want a pretty high rate of return on stocks to offset that. Lower bond yields, means you're going to see money shift into stocks as a result. And, it's also just easier to gauge. Higher inflation also raises uncertainty. It's not just that it's harder, but you don't know, as businesses, you don't know, will your customers keep paying those higher prices, or do you have to eat those higher prices? Your wages are going to be going up at the same time. Your input costs are going to be going up. It just becomes harder to manage it. You can imagine, you're thinking around as you're balancing your checkbook, as it were, at home. You can imagine corporations are doing the same and trying to guess what everybody else is going to do. When inflation is elevated or shifting around a lot, it creates uncertainty, and that in itself is a negative beyond the fact of what inflation itself is.
And so, why do investors need to pay attention to these monthly reports?
Because that's going to move the market. The market moves a lot on these reports. I mean, that's just what it comes down to. And each one's successive. PPI and CPI tend to come out a little earlier, but those will move things. And then usually a week or two later, the PCE inflation report comes out. But all of them will move markets. The trend is over time on things, but every report, you're looking at it, and then you're trying to gauge with how that changes the trend. So you can see big swings up and down on these inflation reports because you think, wow, that might really change what bond yields and what the Fed are going to be doing over the next several months.
All right, Ed. Well, we'll be watching. Thanks so much for joining me. I'm Meredith Heyman. This is IBD Explained. Stay right here on IBD for more. We'll see you next time.